But let's continue the market conversation right now. We're joined by Rob Haworth, Senior Investment Strategist at U.S. Bank Wealth Management. Rob, great to have you here with us. So let's just talk about earnings first. We've got a really strong start so far. Beat rate up over 80% right now. And that's coming even after estimates had been raised going into the earnings season. What kind of pressure do you think this is going to apply really to the third and fourth quarters for investors as they're expecting now not just beats, but pretty strong beats over some of those estimations?
Yeah, we came into this year kind of concerned that comps would be really tough as we got to the back half of the year, and yet we're seeing investors and analysts start to take their expectations up into the back half of the year. I think this means it's going to be really key when we get to the back to school season and we start hopefully more fully reopening the economy and get people back to work. Right, we've got 9 million job openings according to the last JOLTS report. And getting people back to work will be key for that next leg in this economic recovery, and what could be a fairly good earnings recovery that continues to support this market.
So then what are you anticipating for the second half of the year? Because we have seen a little bit of volatility. Of course, we saw that sell-off on Monday. Some folks that we've been talking to have said, frankly, that we do need to expect some choppiness going out ahead. What are you anticipating? And really, where are you seeing opportunity right now in this market? Because I'm looking at prices and things are looking pretty pricey out there.
Right. Prices are moving higher. For us, we do anticipate volatility until we get to that back to school season. There's just not enough evidence yet that we're fully back to work. And certainly the news today around rising coronavirus cases and hospitalizations due to the Delta variant is going to cause some concern in markets about earnings and economic prospects going forward. But that said, there's that back to school season is going to be key, and we think that is probably on balance positive. We remain constructive on risk assets as we get into that fall season, and we would look really at what happens in that season to determine which way we might go. There are kind of two paths. I think one potential path is if we get to the true economic reopening, the labor market starts to ease up and people get back to work. That could be a cyclical story, meaning financials, materials, industrials could do better as activity really ramps. Alternatively, if there's still a lot of dislocation in that labor market, we have a lot of supply constraints, that could be more a story of secular growth as we get into the back half of the year, meaning kind of the winners we've talked about today already, technology, communication services, consumer discretionary, probably hold up a little better because we're still not all the way back to reopening and getting into a more normal economic cycle as we move forward.
And what about protection against some of that volatility, against some of those downside risks that we are seeing? How are you looking at portfolios? How should investors out there, as they're looking at their portfolios, really think about some of those more defensive plays going forward?
I think that's the challenge. We haven't even seen defensive plays hold up very well in this environment. Utilities, consumer staples have been laggards even over the last few weeks. We look more towards quality names, some of the secular growth names as we've talked about, and then even real estate has actually held up okay in this environment. Those are probably really the more defensive plays in the economic portfolio. And then bonds remain important. Yields are extremely low, but bonds remain an important component of diversified portfolios. We would probably tilt more towards taking on credit risk, taking on lower quality credits because the economic environment still looks good and investors look pretty solid when it comes to lower quality credits at this point in time.
You know, Rob, this week we just haven't talked too much about some of these infrastructure and budget packages, at least in terms of how they're going to impact the markets. It wasn't too long ago that Biden had made some announcements on a bipartisan infrastructure deal, and we saw a big pop and rally in the markets right after that announcement was made. This week, not too much movement, it seems, around that news. What are you anticipating going forward? It seems like there's a lot of tensions right now. It doesn't look like, it looks like bipartisanship is really a long ways off. How do you think the markets right now are either pricing in some of these moves around what's happening on the Hill, or how are they looking at some of these really big spending packages?
Yeah, I think for the infrastructure bill, that we're probably a couple of weeks off and it will get it will eventually get passed. I think the market is just waiting to see what really happens with it, and not repricing too much as we think about the infrastructure bill. The key is what comes after. And in particular, we need to get into a budget bill. We need to get into extending the debt ceiling, and that includes some of the bigger spending items, the human infrastructure bill, as the Democrats are calling it, and a tax policy. And that's further down the road. And I think the market's really waiting to get past that back to school season, get the infrastructure bill done and priced in, and then they'll start to grapple with what do the follow-on bills mean? Because I think there's a lot of questions as to what will actually get through Congress as we start to head very quickly here towards next year's midterm elections.
All right, Rob Haworth, Senior Investment Strategist at U.S. Bank Wealth Management. Thanks so much for joining us. Have a great weekend.